Financial Insider Weekly. I'm your host, Michael Gray, CPA. I'm a little froggy today, so I apologize for that, but we're just going to charge ahead and do the best that we can here today. My guest is Craig Martin. Craig is a certified financial planner. His company is called the Family Wealth Consulting Group. He is a fee-only financial planner, and he's been providing asset management services for about 33 years. Ooh. Craig is also the author of Asset Class Investing, and it's an excellent little book about investing. And I'll bet you, if you got in touch with Craig, he would be glad to send you a copy. And I'll bet his wife would be even more glad. So anyway, so consider that. Craig, thank you for joining me.
I'm glad to be here, Mike. You've done a superb job of recording some of the best financial minds here in the Valley. I'm proud to be amongst that group. So you've recorded through the last years that you've been doing this some great ideas.
Great, thank you, Craig, for that. Today, Craig and I are going to be talking about using alternative investments to reduce investment risk. And this is sort of Craig's thing. So
yes.
It's something that he's become more and more active with, and it's something that maybe they don't think of asset managers being that involved with. It involves a lot more attention and due diligence than a lot of the typical investments. Craig, people are talking about investment alternatives a little bit. They describe alternatives as anything but stocks or bonds.
That's my definition, yes.
Okay. And so why are alternatives becoming maybe more popular than they've been in the past?
Well, if we hold the definition that you stated, that alternatives are anything but stocks or bonds,
yes,
then it does not include REITs or ETFs, but does include direct investments in managed futures. How about real estate? How about oil and gas, pipeline? Those are the kinds of things that we would consider in an alternative portfolio.
Mm-hmm. Okay.
The idea is that when stocks got one price movement, that alternatives are going to have something different.
Uh-huh.
So investors are looking at alternatives when they get frustrated or scared about what's going on in the stock market.
Yeah, so I think that's a big thing. In another interview, we were talking about that. I think you said about 37% are in the stock market, which means that somewhere around
63 are out. Yeah,
yeah, about 2/3 of the people.
And that's because they panicked out in the last recession.
So those people are looking at someplace else to put their money in some cases.
For
yeah,
since 08, 09.
Right, about 5 years now.
Yeah.
So, okay, so we're getting diversification to reduce investment risk, but also just looking maybe for something, maybe, I guess they're thinking, for example, real estate. Oh, it's concrete, I can understand it, it's here, I can see this house, I can walk in it, and what have you. Okay, well, maybe you could explain to us a little bit more about what you mean about managing the risk of a total portfolio.
Yeah, so a Nobel Prize was awarded 33 years ago now. Wow, 1990 is 22 years ago, 24 years ago. Whoa, took me a while to do that math.
Yeah.
And what the Nobel Prize said is that if we mix two asset classes that have different price movement, that we end up with a portfolio that has less volatility in price movement than either ingredient. And more return than one ingredient.
Right. So since it hasn't gone down so much, then it doesn't have to recover so much.
So a risk-managed portfolio has the feature that it has less volatility and doesn't go down as much and doesn't have to recover, doesn't have to work as hard to recover. Okay?
Right.
So risk-managed portfolios produce very important results, two very important results. One is that two portfolios with the same return but one of them has lower volatility than the other. The portfolio with the lowest volatility will end up with the highest terminal value. Okay? The second advantage of a risk-managed portfolio is that two portfolios with the same annualized return, the portfolio with the least volatility of price movement is going to have the biggest payout potential during your retirement years.
Right.
Okay?
Yeah. Otherwise, you could pull out some money when the value is down, and
Yeah.
whoops, now what's, there's
Let me
nothing
give
there
you
to
an
recoup.
example of that. The S&P over the longest period of time, S&P is an index of 500 stocks, buy it and hold it. So over your lifetime, our lifetime, S&P has earned about 10% per year.
Mhm.
But in that time frame, it couldn't pay out more than 4%, actually 3.87. So if it paid out 4%, there would be money there the day after you died. If it paid out more than 4%, you would outlive that income.
So
The money would dissipate to zero because you pulled out so much that during periods of normal volatility in the market, pulling out more than 4% in the valley of returns, the lowest returns that S&P was earning, there isn't enough market movement to recover that lost principal.
So we would just be
So
consuming
by the
our
time-
principal fund.
By the time the next downturn occurred, you hadn't recovered, and you would go lower and lower and lower. Okay?
Okay. A little scary.
Yeah. Contrast that with a risk-managed portfolio where we've been able to build portfolios that have track records of paying out 6% over 40-year time frame. So that's about 150% of what the normal market pays out. That's pretty significant. And the way we do that is to manage the risk of the portfolio. So we're earning the same return as the just about the same return as the S&P, but we're able to pay out. We have higher terminal value because we have lower volatility during the growth years. We're going to have higher terminal value, and during the retirement years, we're going to have higher payout potential.
So that's pretty significant to be able to take out 6% instead of 4%.
Yeah.
We're saying you could take 50% more during your retirement years than you could from a regular fund.
Yes.
Yeah. All right. So when we talk about this business, maybe you could talk a little bit more about this dissimilar price movement, particularly as it applies to alternatives as compared to the stock market and so forth.
Yeah, so IBM and Intel would have similar price movements over time. They're positively correlated. When one goes up, the other one goes up one or very close to it. And when one of them goes down one, the other one goes down real close to it. In contrast to stocks and bonds, what we see is that stocks tend to go up when bonds go down in value. That is a long-term trend in the market, but doesn't happen every time during short periods of time. Over the longest periods of time, when bonds go down, stocks go up. Okay.
And part of the reason is because the interest rates are going down, I guess.
Yeah, we could talk a lot about why.
Yeah, okay.
I won't get into that.
Okay.
I'll just talk about the correlation to price movement.
All right.
And what that means is that they are not positively correlated.
All right.
As stocks go up, bonds don't go up.
Right.
In fact, go down.
Right.
Okay. Any asset class that's not a stock is going to have dissimilar price movement to a stock.
Just because it happens to be a different animal.
By definition, yeah. So real estate has a different price movement than stocks or bonds because it's not either. Okay. Oil and gas tends to have a different price movement than stocks or bonds or real estate because it's not either. Okay. That is a way to build a diversified portfolio with many asset classes that have all of which have dissimilar price movement to each other. Mm-hmm. And the Nobel Prize, the Nobel laureate, said if we mix a whole bunch of dissimilar price movement, we just continue to reduce the risk, the volatility of the returns in that portfolio. So the S&P has this much volatility, we add bonds to it, it's got this much volatility, we add real estate to it, we add oil and gas, we add managed futures. Pretty soon the volatility gets very low. We don't know yet how low it can go. Mm-hmm. Nobody's done research on that yet. Okay? And the primary reason is that things like real estate and oil and gas and managed futures don't necessarily have daily price movements. So we know what real estate bought and sold for, but we don't know what happened in between for any particular address. Okay. So it's very difficult to do that research, but the Nobel Prize says that the more alternatives we add to a stock portfolio, the lower that volatility is going to be. Mm-hmm. And the lower the volatility, we get those two benefits, greater terminal value and greater spendable income.
Okay. Maybe you can spend a few minutes explaining what efficiency means for investments and how does the efficiency of the other investment alternatives compare to efficiency for the stock market?
Well, I would look at the market as efficient or not efficient. So the publicly traded stock market, all of us have the same, all of your listeners and you and I have access to the same information about any one stock. We can buy or gain access easily to every piece of information that's available about a publicly traded stock. That makes that market, if not very efficient, at least increasingly efficient. Increasingly efficient means that as new information is added to the marketplace and we all get access to that, one of us might get it 1 second earlier or 1 hour earlier, but the point is, very quickly all that information is disseminated widely. To assume that any one person could read the same information that everybody else has got and find things in there that nobody else can see or know is an unrealistic assumption. It could be that any one stock market analyst would find something that other people haven't seen yet, but that might happen once or at most twice, but to expect it to happen consistently, repetitively, and economically over time is unrealistic. So how do we invest in an efficient market? Well, you buy every stock and you hold it. So most of the professional endowment funds, pension fund managers, institutional managers are telling us, the investing public, look, just buy an index, buy the whole market, and hold on. Don't try and pick stocks and time the trades. Don't try and research something and find information about a stock that isn't already included in yesterday's trade or the most recent trade. That's in contrast to an inefficient market. So if we look at the stock market, who is able to outperform a simple buy and hold of an index fund in the market? Well, over short time frames, in any 1 year, less than half do. Less than half the managers outperform an index fund. Mm-hmm. By the time you get out to 10 years of cumulative returns, something like 20-25% are outperforming. Somewhere between 10 and 15 years, that number drops under 10%. And at 20 years, it's down close to 1%. 1% of the managers
but we don't
are
know
able
which
to
one it's going to be.
they're researching the information and trying to find out which stock to buy and when to trade it. And what we discover is that they're not outperforming a simple buy and hold over your lifetime. Okay? That proves to me that the market is pretty efficient, if not very efficient. Those managers are able to get excess return for a short period of time, intermittently, but not over the longest period of time. So basically, that market's very efficient. In contrast to a market that would be inefficient, well, the way I identify that market is that I can find real estate managers who have 20 and 30-year track records of earning 20% return per year. If you'd invested $1 into every one of their deals, you'd have earned 20% or more over that 20 to 30-year time frame. If I'd purchased an index of real estate, say a REIT index, real estate investment trust index, over the longest period of time, they tend to earn less than the market, between 6 and 8% per year. The market's at about 10. So real estate is growing at about 6 to 8% per year on average. And here's people that are able to get 20 plus over really long periods of time. That convinces me that real estate is an inefficient market. If I can find the right managers, then we can put them into a portfolio. My clients can invest into a whole bunch of those managers, and we can build a portfolio that has an expected return close to the average that they've produced in the past. Okay? I think the same is true in other asset classes. So we've built an alternative fund with what I call inefficient managers.
Managers of inefficient assets.
Managers that are able to trade in an inefficient market, harvest those inefficiencies regularly, repetitively, and economically, and bring excess returns to my clients. Yeah.
Okay. What are the differences between the public and private real estate markets, and what are the advantages and disadvantages for each?
So real estate's a classic alternative asset class, and there you can invest in real estate with very low dollar numbers. A real estate investment trust, for instance, is a bucket. You put your money into this bucket, they call it a trust, and the manager of that bucket is going to take your money and go out and buy real estate. Typically, they buy 100, 150 different addresses of very expensive real estate, not single-family homes for the most part, commercial buildings, retail shopping centers, and because you own so many addresses and the manager is buying so many addresses, the efficiency is not very high. In contrast to one manager, a general partner who puts together a real estate limited partnership and goes out and buys a small number of addresses, 1, 3, 5 addresses, and is able to buy those addresses in a competitive market and manage them aggressively, itemizing where each dollar is spent, and sell it at the highest price. And I said earlier, a real estate trust over the longest period of time tends to underperform the stock market. Stock market's at 10%. So we tend to see REITs yielding between 6 and 8% per year. In contrast to, I'm able to find private real estate managers, general partners of real estate limited partnerships, who have track records in the 20 and 30% range per year. If you'd invested $1 into every one of their deals, you'd have earned 20 or 30% depending upon that manager.
Yeah. So the trade-off that I see between the real estate investment trusts and these private deals that you're talking about is hopefully you're going to get a better return with the private deal because, again, you've got this manager who has the track record, knows how to identify these opportunities.
Yes.
But with the real estate investment trust, one of the advantages, for example, is liquidity. You can sell your shares in the marketplace.
Excellent point.
Yeah.
Excellent point.
Yeah.
So you can sell a REIT it's a trust, therefore it has a share to it. It's publicly listed every day, and you can buy it today and sell it tomorrow and buy it back the next day. Once you put money into a piece of land, though, by a general purchase in a real estate limited partnership, there's no liquidity until that general partner decides to sell the property.
Right.
Yeah.
Okay.
Typically, that general partner is paid a percentage of the profit, and so is anxious to sell that property as quickly as possible for the maximum profit.
Okay. So there are a lot of people that have made money here in our Silicon Valley, where you and I live, by buying and holding real estate for many years. Would you recommend that as an ongoing approach?
Earlier I said that on a national average, REITs, real estate investment trusts, buy typically hundreds of addresses,
Right.
and they're all over the country, and they tend to appreciate at about 6 to 8% per year. If you buy a piece of real estate for, used to be able to buy them for $50,000,
Not
okay?
in our area, but anyway, yeah.
And there was a time when we saw that double in price in
Yeah.
just a few years.
Right.
It was common for investors to hold that property even after it had doubled in price for the next decade or 3 decades. So doubling in 5 years meant that you were earning 15% per year, and that could be double what the national average is. Had you sold it at the end of that time frame, you'd have earned the 15% per year. But if you held it for another decade or more, the assumption is that that return would have dropped each year to a national average, approaching something less than 10%. So you made a whole bunch of profit in a short time frame, but didn't take advantage of it because you didn't sell it, you held it. My goal is to get my clients that short-term high-yield return, buy it at the right time, hold it for the shortest period of time possible, sell it and get out. Take our profits and go into the next deal.
Okay. So how much of a portfolio do you think you should allocate to alternative investments?
Oh, good question. So if you have a stock portfolio and are considering alternatives and want to put something, a part of your portfolio into alternatives, it's difficult to know what the best allocation number is. The research in the marketplace just isn't solid enough to tell us. Is it 10% or 20% before the needle starts to move, the risk starts to reduce? But it's real clear that the more alternatives you put into your portfolio, the lower the volatility. And the biggest institutional investors, Dave Swenson is the manager at Yale Endowment, Yale University Endowment, and his allocation to alternatives is 70% of the total portfolio.
I'm sorry, for alternatives was 70%?
70%.
Well, that's really heavy, isn't it, into alternatives? That's amazing.
It is if you consider a history of only investing in liquid marketable stock with 100% of your portfolio.
Yeah.
The thought is that at my age, whatever age the investor is or your listeners are, at my age, it's too late. I can't get into alternatives because real estate's a longer term hold, and I would not be able to get in, not be able to take advantage of that at my age. And my answer to that is no. I've got clients that are in alternatives at age 85 and have 40% in alternatives. And he and I just have a real solid agreement that I'm very good at managing those alternatives while he's alive. I'll be very good at managing them after he's gone, so that his children, his heirs, get the same benefits.
Okay. What's the minimum investment required to invest in private offerings?
Normally, those general partners who put together real estate limited partnerships and buy 1 to 5 addresses inside that partnership, the minimum investment typically starts at $100,000. So for a millionaire, your viewers have $1 million in their portfolio, $100,000 is 10%.
Right.
That's a heavy commitment into one deal.
Right.
Okay. My clients are doing it through a fund that we have, and they're putting much less, maybe $10,000 into each deal. So for each limited partnership, they're able to invest $10,000, and then I go find other clients and they invest $10,000 until we meet the minimum, and then the fund buys that $100,000 interest in that real estate limited partnership. And so my clients are able to get dozens of real estate investments or other alternatives because they're only investing small amounts in each one.
Well, Craig, we only have maybe about 1.5 minutes left. Maybe you'd like to just throw out a final thought related to this area of investments.
Yeah.
Maybe a last piece of wisdom, if you will.
Sure. The investment world is dominated by Wall Street. Wall Street has trained us to think that we can buy and sell frequently. And the way my clients have built their portfolio, we work under the premise that diversification is the only safety, and that in an efficient market, we want to buy and hold. In an inefficient market, we do want to trade. So the stock market is at least very efficient, if not increasingly efficient. So we buy and hold. But in the alternative space, we're trading as frequently as we can, buying something every month. My clients continue to diversify their alternative investments nearly every month, at least quarterly, buying new investments for small amounts of dollars into each investment. Okay, which means they end up with dozens and dozens and dozens of alternatives. So under the belief that diversification is our only safety, we are diversified in the efficient market and increasingly diversified in the inefficient market.
Okay, great. Thanks so much for joining me as my guest
Thanks,
today.
Mike. Real glad to be here.
Folks, I hope that we've given you some things to think about, especially because, again, a lot of people are thinking of other alternative ways of investing aside from the stock market. So we hope we've given you some ideas to work with today. We'll see you next time on Financial Insider Weekly.